Hi, everybody. Welcome to another edition of Your Money Radio. Danny Stewart, Don Vandervoort, and this new fellow right here, Hunter Mazingo, newest member of the Revere Asset family, who just waved to you. We will get to Hunter in a moment. We have lowered the age by an exponent of at least 10 in the office, so which is awesome.
Keep going.
So, but I before we get to know Hunter, which we're going to do through a story about Michael Kittis. Is it Michael Kittis? How do you pronounce that dude's name in the Twitter?
Kit, yeah, something like
that. Say it for me. Go ahead.
I think it's Kittis. Kitces,
right?
Yeah.
Do you know how to pronounce it?
I call him Kitchis. I don't know if that's right or not.
You know what? That dude is in the swamp, and I got a story with him in Northwestern Mutual we're going to talk about here in a moment. Look at Don's concern. Michael, in the swamp.
Do I need a mute button?
Yeah, but before we do that, I want to talk about the most boring topic I could bring up on the show, but a lot of people do it in our universe, the stock nerds and market lovers. Covered calls. Not exciting, right? But let me show you something that I'm having a great day market-wise. So not with I got some GameStop, but we'll talk about GameStop in a moment. Let's look at Piton here. So I've got some Piton. We bought Piton, Danny, in the shop 924. I'm doing this from memory. 924, I believe. No, 929 is when we bought Peloton. Peloton is having itself a hell of a day. All-time highs today, Danny. Like,
yep.
People are giddy up and ride on Peloton, right? And so 929 is when we bought Peloton. But Danny, I did something I've been doing for the couple of weeks that I've had the Peloton. So here's 929 right here on a daily chart. I mean, this is just, look at this stock. I mean, hits the 5, can't even really come down to the 8, and it's just been a straight up shot. So what I've been doing is selling. I typically trade in options. So instead of buying the shares, I buy the calls. And so, but what I've been doing is creating a diagonal by selling calls against the calls that I'm long. Danny, does that make sense? Do you need to explain that with the Tim interpreter to anybody?
Yeah, well, it's basically a spread.
Yes.
You're hedging your position.
Yeah, across different weeks. So to give you an example, when we bought the position on 929, you know, what I would do is I bought the Octobers, and I'm going to show you all this in a second. The Octobers, this is going to end up, let me just show you where the story is going to end up. That covered calls are not a great strategy because I think, and that's the controversial. That's the controversial part, because you're stepping in front of a train to pick up nickels and dimes when you're missing a ton of dollars, in my opinion. And so, and we're going to get into that here in a moment. So October, I bought the October monthlies, and then I bought the November earnings season. So I've got 2 series of calls. And what I did for last week and for this week, I sold the 110s and I sold the 117s against it. And so, Danny, look at the soup that I'm in right now with Peloton. So Peloton, hold on, let me see if I need to see you guys. So what I'm doing this so I can see. Sorry to do this to y'all. Can you guys see me? You guys can. Okay. Yeah. So look at the soup I'm in here, Daniel. I was trying to get my theta down. So every moment, every minute of time that ticks away, there would be quote unquote money coming to my account. So, but I made a huge mistake here. I sold the 117s on Monday or Tuesday when Peloton was, it spiked up a little bit, but it looked like it was going to stick around 110. And so how I do this, and how, if you're going to execute a covered call strategy, what you need to have a firm grasp of is what's known as the expected move. So when I sold these 36 calls for $1.15, the expected move was $7, and Peloton was trading at 110. And I'm like, well, that's perfect. I'll take that. 80% of the time, you're going to get that data, and it's going to come right back into your account. Not a problem. That last week, I sold the 110s. Perfect. Had myself a great week. This week, though, look at this, Daniel. I started the day, and I've got a screenshot. So last night, when I went to bed, let me show you this screenshot. Same. So here is 359 on 10/8. So my theta was $850. These were 70 cents. Now look, I would have closed these out this morning for a nice gain, but I purposely let these go so I could do this on the show. And well, c'est la vie. And so we'll see if they come back a little bit. I'm not expecting it to come back to 117. So, but I'm having, let me minimize that. I'm still having a great day in the stock, but what I've done is I've capped my gains here just a little bit. So I'll close these out before the end of the day. But my point being is so many people advocate these covered call strategies, and to actually make money with this, it comes back to risk. If you have a stock, and Microsoft is one of the most popular stocks to sell covered calls against, there's not a lot. Like if I type in Microsoft here, MSFT, there's not, look at this implied volatility. Next week, 25, 28, 33. That's not a lot of implied volatility. So the calls you sell against your shares, you're not being rewarded enough to take that risk to have your stock called away. There is a bunch of people right now, Daniel, with Microsoft up 2% on a Friday, that are having their stock called away because sure as hell, they didn't think Microsoft was going to go above 210. It's a big level, right? There's a big psychological level. And if you're trading against the news, like how you think the market should be reacting to, I don't know, is the president fit for duty? Are we going to have a stimulus? The hell knows. I don't know. But you're having your stock called away, and that's a problem because you've got a winner and you want to ride it. And so many people have their shares, in fact, called away. And so if I go back to Peloton, if I can type, Peloton. So look at the implied volatilities here. 61%, 67%, 69%, 86, 86. That you're getting paid to take that risk, and you can in fact go out further based on the implied volatilities that you see. That's a dollar figure right there. You can do that, but here's where I made, Daniel, here's where I made a crucial error. I should have waited till Wednesday or Thursday is what I should have done. I sold them too soon is what I did. But I still, even though I did it, and you're like, well, Tim, didn't you have a successful operation last week? I sure did, but it's not worth it. Like the 4,000 in credit I took in, you can see now it's a $6,000 loss here. I got to cover this here shortly. It's actually coming back. It was 120. We'll see if I can recapture another dollar this or so by the end of the session, but it's not worth it. Like you're standing, I've got a high implied volatility stock. When the stock pops, and that's the thing, when the stock pops from a consolidated phase, you don't want anything to stand in its way. And so I would rather have, whether you want to classify it as a growth story or not, I would rather have a stock that has all the characteristics, that make a stock want to go up. It's consolidating on the timeframes that we talk about all the time, stock nerds, from a daily to a 4-hour to a 78-minute to a 39-minute chart. And then it has all the characteristics that make it want to go higher a price. And you could have picked off to show you that. Like if I take Peloton down to a 195-minute chart, there's a period, this is back here. At the beginning of the month, there's a couple periods in here where it consolidates. And if you can't see those because your eyes just not trained, take it down to an hourly. You know, there's plenty of places like a test of the 21 on an hourly chart from Thursday, which is a common, look at how this does this. When I say it's common, 21, 21, 21, 21, 21, 21, 21. I would rather have a stock that I know how it's supposed to behave, and it's not behaving that way, I can sell it. Vice have a stock, how many people sell covered calls because they own just, oh my gosh, Danny, I didn't even know this. Look at, do you see what GE's doing today? This garbage stock, General Electric. You see what it's doing? It's up for 29 cents, Danny, is a 4.3%.
That's bailout speculation right there.
But think about it. How many people are swamped with they're just swimming in General Electric stock, and they're like, well, I sell covered calls against it, and now General Electric might go higher, and they're going to get their shares called away. It's selling covered calls is great when the market's sideways to, sideways neutral. But if you can't understand what state of the market we're in, covered calls is absolutely positively dangerous. And so dangerous, well, how, Tim? I've got the stock to cover it. Yeah, but you're going to get potentially one of your biggest winners called away. And so you have to understand how to read the market. So if I take this to a daily chart and we go back to, let's look at the ES. So we go back to the ES on a daily chart. Let me try to zoom in. So here is some pivotal moments in time. We talked about this last week, 923, 924, you hit a low, but you try to retest it on 925 and you never get there. That's that we talked about that. I was buying. That's the day you want to be buying. I was buying a little bit before this in some things and buy it all the way through this. And so was Don. And then we're still on a daily chart. And you're like, well, you don't have to catch the bottom and make a lot of money. You just have to understand that a shift in trend starts at the mean. And well, that's around the 21 exponential moving average. You get 2 closes above the 21. That's at 33.50. You're a full 100 S&P points higher. You, my friends, stock nerds, market lovers, can make a tremendous amount of money on a 100 S&P point move. You just have to know where you are in the state of the market. And so we tell you all the time, do not trade the news. You can't interpret it. We say oftentimes first price, then news. And what that means is that the media is going to shape an action in the news that happened around price, when in actuality, you want to shape price first and then go, oh, there's probably some news coming out. The market is a forecasting vehicle by about 6 to 8 months. And so when I'm looking at this, we talked about these levels the other night in the video. So here's a 50% retracement from the recent high to the recent low and the 618. You get through the 50%, it's just so high probability that you're going to go up to the 618, and now you busted through it. And last night I was talking about the NASDAQ's probably going to do the same thing. I didn't know if it would do it today because you just have to be ready for it. And so, yeah, here you are. There's the 50%, and you're traversing your way up into the 11,782 level. And so you still have room to move. And how many people, I mean, how many people in the universe went short or aren't participated because they saw that a politician was going to have a news conference today? And you miss out. And then if you see what's been leading, like what would give me the thought that the NASDAQ could catch up to the rest of the market? Look at this moving, the Russell, the junk stocks. Look at these. And that's a lot has to do with oil. 2 closes above the 21, bust through the 50%, bust through the 618. You just went up to the 1272 from a high to low. and it's improbable to so many. And so you want to sell covered calls. Maybe do it when the market is going lower. But covered calls are picking up, it's oftentimes picking up dollars. I mean, picking up nickels in front of dollars. You're missing the dollars. And it's just not worth it. Danny, what are your thoughts on covered calls? And can you unpack anything that I said that may be confusing?
Well, the biggest thing about it, I was talking to Don about this about a week or two ago, and Don said something that was very apropos. He said, first, you got to learn how to trade stocks before you can trade options. And way too many people try to just do this covered call strategy. And there's actually guys that will go teach these webinars every year where you screen, especially nowadays with no yield in bonds and dividends. It's so low that people are looking for extra yield. They're hungry for it. And so they'll teach you seminars where you screen for the highest yielding options. Ooh, this option on this stock, this covered call for a month has a 5 or 6 or 7% dividend. That just means it's more risky. Normally what that means is the stock's already had a big run up and people extrapolate, think it's going to continue going up. So it's got a high premium, okay, but the stock is risky, it's extended. And so now you buy the stock, you get and do the covered call simultaneously, you may get a 6 or 7% premium, then the stock drops 20%. Are you up? No, you pay tax on that short-term capital gain, that premium, but you got a 20% loss in the stock. Now, if you're going to do covered calls, look, call me old-fashioned. I consider it a return of principle or lowering my cost basis first. You really never know the real return until you unwind both positions. But really the time that you're going to do covered call, the only time that makes sense to me is if I'm actually really want to hold that stock for a while. I buy the stock, it runs up. Now I think it's pretty pricey. It's pretty either extended or pretty fully priced. And so I'm okay to let it go. And I may sell a call that's just a little bit out of the money or right at the money, get a lot of premium. And if it gets called away, I'm happy. but if it pulls back, but that's really only if I'm going to hold the stock, because it's much better to control your destiny and either keep the upside open, and when it starts getting weak, just sell the stock and move on.
Yeah, because days like today, like let's just call a spade a spade. I wish I had this strategy on. Hell no. I mean, look at this. I sold 36 of them at $1.15. I'm going to buy these back. I've capped for today. I've capped my upside when I buy these back. Now, yesterday when Piton was down, I was like, oh, I'm pretty freaking smart. And there it lies. So I've pulled them off yesterday. Yep.
Well, listen, my own CPA that we manage some of his money, but he loves these covered call ideas. He thinks it's sexy, so he's got his own account that he does a little bit on. Because I told him, I said, I don't agree with that. You need to just do that on yourself on the retail side. So he goes over there and he had a bunch of shares FedEx. So he calls me, and goes, oh, I get a big premium. What do you think? I said, look, just do it on do it on 100 shares. Do not cap the upside on all. And luckily, he left some open, a couple hundred shares open, and he only did it on one because now FedEx has just gone on a tear, and he's going to get called away on that 100 shares. He'd have been much better off not doing it.
Yeah.
So
that's
at least he's got the other 200, 225 that he left open.
Absolutely. Excuse me.
Hey, Dan, back to that comment that I made about learning to trade stocks and before you trade options. Correct me if I'm wrong on this. If you're fairly new to the options market, and you've got a $20,000 account, and you buy, I'm hearing an echo somewhere. Are you guys?
Sorry. No.
If you buy $20,000 worth of options in your $20,000 account, and suppose they all have a delta of 80, didn't you effectively just lever your account by 8 times?
Well, yeah. So
principal.
If you've got a $20,000 account, you can't fill it up with options because options are kind of leverage on equities. Now, if you buy the options, not selling, but buy the options.
That's what I'm saying. I'm talking about buying them in lieu of buying common. Somebody that says, I can't really afford that much stock, so let me go the options route.
Right. So you can hang on. So you can only lose your premium. Well, here's the problem. It works out in assuming you're doing calls, your long calls, you can only lose your premium, but then all of a sudden some big event comes and you have a big sell-off, and now you get wiped off across the board. Position size is key. So if you got a $20,000 account, you really only want a couple, $3,000, $4,000. I mean, depending on which strategy you're doing, you only want $2,000, $3,000, $4,000 in options, and then a lot of cash because
you want to do it by percentage. And so
exactly.
I always tell people to work with. It's easy to say, well, only work with what you're comfortable losing. And when you make 100% on an option, people are like, oh, I'm comfortable losing all of it. Or they say things like, I'm playing with the house's money, which is a dangerous phrase. If you cap yourself at 3 to 5% positions, that you can do a lot. And it comes down to setting risk reward too. Like spreads are more forgiving. When you buy a vertical call spread, what you're doing is you're taking theta decay from the top and you get the call move from the bottom. It's a lot less risk, but most people it's greed is what takes over. Greed takes over, the leverage takes over. And when you start making money with options, eventually you'll go down the road to ruin. And then you'll figure out that you need risk control. And there isn't an options trader alive that hasn't done it. So if we set that as the basis that, oh, wow, I didn't realize I had that much leverage on, you come to respect even stock that you buy on margin, that's leverage. So you come to, or you buy leveraged ETFs, you come to respect the risk and then you treat it appropriately.
Well, yeah, but back to your point, you're buying 4 or 5% positions. And what I'm telling the stock nerds and the listeners, don't go buy 4 or 5% positions and fill up the whole account and be all one direction. So if you're bullish and you're filling up with 100% of options, even if it's 3 or 5% positions, once you get in a big correction, you'll lose all. You'll get your clock.
Oh, people have no idea. Like this
so well, I just wanted to clarify, Tim, because what you're doing is you're taking 3 and 5, 6% positions, but you're not filling up the whole account with that. That's a little different. That's what you got to be careful.
Yeah, and the other part too is people. There's so much that comes into it with theta decay, where like the stock can go in the direction you thought, but the adding that I don't know if you want to call it a third dimension of time, you got to get direction right first. Like you got to pick a stock that has the impetus to go higher. Like you have to know the common traits, not just it trades with the market. Buying stocks that trade with the market, you'll get market returns. You need to buy stocks or you need to find the stocks that have the impetus to outperform the market. And it's not just based on beta, it's based on the 7 common traits that all great stocks have before they make their biggest price moves. You got to find those stocks before they make their biggest price moves. That's step one. Step two is then, okay, what stocks those, and then out of that group of stocks, which ones you're going to buy. And then step 3, if you're going to do options, now you got to pick a time series, and time works against you the way options are priced. It's the time function, because you can be right on direction and wrong on time and lose your ass. And you have to be, it takes practice, just like anything else. And so, like I usually only buy Delta 50 or Delta 70. I typically buy Delta 70 calls. That's gives me the right mix of premium to intrinsic value. And then when I take positions, I'm doing it with size that's appropriate for my account.
So Delta 70 means it'll move 70% of what the underlying moves.
Yep. So 70
So that
cents
means if you
$1.
had a $20,000 account and you're loaded full and they all were 70 Delta, you're effectively leveraged 7 times your account.
Yeah, you could. Yeah, depending upon the number of contracts you have, right? Mm-hmm. It is.
Well, that's the other thing you really got to monitor very closely. You cannot. I mean, you got to watch them even closer than stocks because they move much faster. And the other thing is you've always got to take them off before they expire. You never let them go into expiration because there can be games played.
No, oh my God, that's the biggest. That's why you want to use price targets and Fibonacci, or you need to have a game plan going in. The person that says, well, I'm going to let it, I'm going to nobody exercises options. Why would you want to do that? And so, people don't realize, like there's people that teach option strategies and they'll say things like, this is, out of your $100,000 portfolio, risking 5% of your account, and this is only X amount. And what they don't tell you, because they're just trying to sound smart, or they're trying to sound sexy and sell you on something, is you're actually risking 100% of that premium. That premium can go to 0. So it's not, I mean, if you want to look at it in total of your portfolio, if you're not comfortable with your premium going to 0 and you wake up to a disaster one day, which happens, then you need to, 1, trade size and give yourself the gift of time, and 2, trade size that's appropriate for your account. So many people don't. So anyway, but I was just, that was, Danny, did you get everything out about covered calls that you don't like about covered call strategies?
Yeah.
Don, any other thoughts before I?
No, I think the important thing for new people to know is, just because you're sitting there with half of your account in cash and half of your account in options, you're only your risk to the account is not half of what the account value is.
Here's the thing for new people: if you're going to try to do that, you need to take maybe 10% total of your total account and do a few first to get used to it.
There is absolutely positively nothing wrong with being captain one lot. And the options are so pricey these days because of the market's fluctuations. You want to buy options in Amazon at Delta 50, you're going to spend Delta 50 options going out 2 or 3 weeks right now are trading, Danny, at $15,000.
Yeah, you can't do it for a small account. You can't do Amazon. You should not be doing Amazon if you got a small account.
And so,
if you're new.
Well, that's buying options. There's a lot of things you can do to sell options.
It doesn't, Tim. It doesn't matter with a small account. With a new person, person that doesn't understand options, they shouldn't be doing Amazon because you're locking up a lot of. If you get burned, you can completely get wiped out your account.
Yeah, no, you got to be. It's hard. Like I go back and forth with. I understand what you're saying, But how does a new person get experience? Probably not trading Amazon
Sure. Well, that was my point.
Yeah, well, that's what I wanted you to get to, but you're just scaring people, and scaring people makes people want
Well,
to try.
I want to for the small accounts that don't know. You've got to learn to trade stocks first, and
Yep.
then you've got to do a few contracts, get used to it before you try to get into it.
Let's see here. Let's move on. So anyway, I will be managing Peloton, but I get a lot of covered call strategy questions, or I get people that sell calls just in general. It's the same thing when they do it naked. Naked's even worse, but we don't need to go down
Yeah,
that.
covered call strategies is the #1 strategy taught by these guys going
Is it
around
really?
the country. Yes, because doing the dog and pony show. Why? Because if it gets called away and they get the stock called away, they still made a little bit of money even though they capped it. But if the stock goes down in value, they quote still own the stock. So they haven't really lost yet. So they can't clean out their account. If they teach strategies that may have a little more upside, but the guy can get burned a lot more and lose their ass, they go after those guys that taught the seminar. So for seminar guys that are not just going out and teaching that stuff, it's a little safer for them to teach.
Sure.
Because they won't make as much on the upside, but they won't clean out the account either.
So Danny, I'll move on here from covered calls. I've got a story here now, Danny. I doubt you've read it, but maybe you'll surprise me. Have you read your new issue of Financial Planning Monthly?
No.
Wait. Are you sure you haven't read your?
I'm sure I haven't read that.
He wrote it. He doesn't have to read it.
I've read a couple of those early on when I first got them, but no, they're decor out in the waiting room. That's about it.
That's what Don called you while we were waiting to join the Zoom call. Danny's just decor out in the waiting room. So
that's because I look good.
Yeah, so
no, that's not why.
Yeah.
I was thinking more of like a paperweight.
Hey, we never asked Don what shirt he was wearing today.
Oh, it's Jaguars today.
Oh. Why?
I don't know, because I'm a glutton for punishment, Dan. Hey,
So,
Danny, you can score 35 points and still lose the game, as you're well aware, right? As a Cowboys fan. Okay.
Yeah.
if you give up 49.
I just wish we'd score 25 points.
Danny, remember our mutual friend, Don knows Brant. Everybody on this call except Hunter knows Brant. And Danny, remember the story I was telling you about how Brant was at church and he thought he was talking about getting rid of his advisor, okay? And Brant's at church. And another advisor had caught wind in the office. He worked in the same office as this other advisor that Brant was considering firing. And at church, the guy jumps over the pews to hit up Brant and tell him, hey, we should be trading buddies, and signs Brant up as his client. And Brant's like, I never agreed to this. And he did it at church. Well, that dude was a Northwestern Mutual guy. All right. And so there's a story in this month's. I'm gonna read this a little bit. I hate to read to people, but we need to dissect this because I don't think it's stock nerds and market lovers that watch us regularly that are afflicted with Northwestern Mutual's disease. What I think is it's their parents and it's their loved ones, because so many people don't know. And what we're about to highlight, this is what you want to. A lot of stock nerds. Dan, you remember when we used to get the questions about people, stock nerds and market lovers would try to have interventions with their friends or their parents. Like, you got to get out of this buy and hold. Look at Don's look. This buy and they would ask us, how do we?
I'm actually having one today. I'm actually after the podcast, I'm actually having an intervention today.
But it's the truth. Like, we get like, hey, what's the best way to talk to my folks about this? And the answer is, don't come off as a know-it-all. What you want to do is come across don't come across, be sincere, have a tremendous amount of empathy, because the things that we're about to talk about, nobody's talking about. And the things that I'm about to, I shouldn't say this because I wrote about it this month. And we've been talking about this stuff for years. But the best way to have, one, don't call it an intervention. Two, bring it. The best way to do it is over the course of time is to bring up a couple different things that you're doing for your accounts in a non-braggadocious way. And there's a really good chance that your parents or your loved ones, if you're having success, would like to follow. Success begets success. Success, winners, people want to be around winners. And they'll come about to it naturally. But we used to get so many emails. And then Danny would join these interventions on the phone. We haven't had one of that. You're having one today, Danny?
I swear. So Stock Nerd reached out to us the last couple of days and said, hey man, you got to help me. It's my mother and
That's a bummer.
Anyway.
Okay, so here we go.
So the sister and the brother are bringing the mother over to have a little come to Jesus meeting, have a little talk because they don't like where they were.
And so here's the headline: Northwestern Hunter is on. Why Hunter's with us? Not why Hunter's with us, but where Hunter was in life before he joined the forces of good. And so here we go. Northwestern
from the dark side.
Yes. And so Northwestern Mutual's Hunter, how old are you? 23? I got you at 24.
Just turned 25 September 30th. So
nice.
Very fresh. Yeah, you're close.
Your eyebrow game is strong. You got like Danny eyebrows.
Thank you. Well, that's part of the reason I took the job is I just thought I saw some really good similarities with me and Dan.
There you go. There you go.
And I know you guys, you mentioned,
Dan, I told you he would fit right in just fine.
This kid's smart. He knows exactly who to kiss up to.
Well, you also
Danny, I don't think he's complimenting you.
He's really not, Dan, but go ahead.
I gotta stop you there. I think what he's saying is,
you think there was sarcasm in his voice? I'm taking that as well.
And I'm the worst at picking it up. So if I picked it up, I mean, surely everybody else in America's picked it up. I mean, hell, even in.
I want the Stock Nerds to come. I didn't catch it. Maybe I wasn't paying attention.
Well, it's the Ivan Lendl in you. You can't. You're German. You can't figure it out.
Johann Krieg.
Nobody knows who Johann Krieg is. It's the best part about the show when you throw out the most obscure. Ivan Lendl's obscure, and you go.
He is kind of. He and Vatsvilander.
You play tennis, Hunter? You play any sports? No.
Basketball primarily. Yeah. I love football, but you can't really play that as much. So I play a lot of pickup basketball. More of a football fan. Along with Dan, we've had some interesting fantasy football discussions as well. But I love basketball. It's just not as fun to watch right now.
Dan's fantasy football discussions center around the fantasy that the Cowboys are going to ever win a Super Bowl again. That's what fantasy.
They say it every year. Doesn't seem to pan out though. And I like the Cowboys. Elliott's my running back.
I know. How are the Eagles doing this year, Tim?
Hold on a second.
Great. They look great.
Listen, this is what you do with the Eagles. You buy Carson Wentz rookie cards on the dip. It's the only thing I buy on the dip. Bunch of Carson Wentz rookie. I can't.
Tim's recommending buying the dip.
Yeah, I've been buying the dip on Carson Wentz
sports cards.
What does Ric Flair think about that approach?
Been buying the dip on Carson when Carson leads us to an NFC Championship game against Nick Foles, which I think. See, the NFL's rigged, Danny. This is the whole thing. People don't realize. The NFL is so corrupt. It's rigged. So they're going to WWE this thing where they're going to get the best storyline would be a Carson Wentz, Chicago Bears NFC Championship game. I think that's the storyline. So all this stuff was written months ago. Like they've got the storyline set. Do you see Nick Foles beat Tom Brady by 1 point yesterday? You don't think that was written back in April? You don't think the Jaguars, the Jaguars had planned to send Nick Foles to Chicago. And by the way, it was written that the Bears would draft Trubisky ahead of, who's that good quarterback in Kansas City? What's that guy's name?
Mahomes.
They drafted Trubisky in front of Mahomes. You don't think the powers in New York dictated that?
Well, hey, by the way, I forgot to tell you, Tim, we've got a client that is, he works in the tech and, business, cultivating businesses and stuff. Anyway, but when he was growing up, he was an avid collector of sports cards, Hot Wheels, and then something else. I can't remember what the other thing was.
Are Hot Wheels collectible? I guess they are.
Some of them were, but anyway, he is very meticulous, and he kept everything in perfect condition. So he was watching our podcast a couple of weeks ago, and he saw you doing the sports cards, and he said, man, it made me go out and look and pull them all out. He has got some unbelievable cards from the 70s, 80s, early 80s, and through the 80s that are in immaculate condition. And he said, I'm going to go price a few and see what they're worth. He's got some that are 5 figures.
Wow. Very nice. Yeah.
He's going to send you a few. He goes, I got a couple in my safety deposit box, but I've got some at home. I'll have to send you a couple pictures. So I just wanted to let you know that, because he was asking me, do you think I should take some off the table? I mean, it seems like it's a seller's market right now. I said, yes, right now I would cash a few of those in. Don't sell them all, but split the difference, sell a third or whatever.
So Northwestern Mutual Life's practice is raise concerns about the nature of retail advice, just as wealth management is facing greater scrutiny under new rules. That's the title here. So the company closely ties. So there's an advisor that has broke ranks with Northwestern Mutual, and he's spilling all the beans to financial planning. Okay, and so you're getting an inside look at what's going on here. We're going to dissect this a little bit. I'll make it as interesting as I can, but the point being is there's so many families that are afflicted with this company that it helps to understand how as a customer you're being treated, one, and how much it's costing you an opportunity cost. And we talk about it all the time, but we can never really we just know. But now this is an independent journalistic organization actually reporting it, and it's interesting. So
you're not the customer, you're the product.
When you're with Northwestern Mutual?
Well, with most insurance companies, even most brokerage firms. The asset gatherers are delivering you to market, man. They're the roper, you're the cattle.
So this guy's name is Rick. I'll send anybody the article that wants it if they want to get a copy of this. Just email me. Speaking of which, if you want to get a copy of this, go to revereasset.com, go to the contact button right here, and then you can email any one of us right here. Tim, there's Don, there's Danny, America's Fiduciary, and then if you like the strategies to which we espouse, which we'll get to here in a moment. All you have to do, if you want to become a client of the firm, we'd love to have you, 855-732-5932. But look, even if you don't want to become a client of the firm, even if you don't, we're here to empower individual investors. Just call us with your questions. You're not in some marketing funnel. That's not how we operate. We're here to help you get better at what you want to get better at, i.e. investing, trading stocks. And we'll do that to the cows come home. We'll help you any way we can. Just understand, we don't have salespeople. Hunter is not a salesperson. Hunter is a research analyst, and so we'll talk about that here in a moment. So anyway, this guy is named Rick Sheeler, who has broke ranks with the swamp. The true swamp in this world is this. I hate this industry because of the Northwestern Mutuals, but that's a whole nother story. The company closely tied Rick's pay to the sale of insurance. It also tacked on amendments to one of Sheeler's contracts, which stated that his principal business activity was life insurance and annuities that are primarily Northwestern Mutual products. So every advisor at Northwestern Mutual, their principal business activity isn't helping you grow your wealth, isn't life planning. It's your principal business activity is insurance and annuities. Just think about that. How many of you laugh at the fact that, or laugh at the thought of going to State Farm, the insurance company, for your mutual funds, even though they offer them? They're just white labeled Fidelity funds, I believe. But that most people don't go to State Farm for their banking needs, even though they offer them, and their investment needs. They go there for auto insurance. Are you going to Geico for your investing needs? So when you want to grow your wealth or protect your wealth, are you going to State? This is what Northwestern Mutual is. It gets better, Daniel. The company has filled airwaves with TV commercials and sponsored major sporting events like the Rose Bowl. The firm's wealth management business revolves around rewarding advisors for selling more of what the company refers to as its core annuity and insurance products. Along with the pay grid and contract language, some advisors decry a sales-driven culture rewarding insurance production over investment advice. They also say the firm charges an extraordinary fee, such as $500 just to open an advisory account. Just so think
But
about
at least
that.
they have them. I didn't even know they had them. I thought it was all commission.
Just to open the advisory account, they're just tacking on fees. Their core business is annuities and insurance products, not advice. Craziness. Okay.
Well, I hate to tell you this, Tim, but the $500 advice account is actually a whole lot cheaper than the annuities accounts. Now,
Sad.
now I know. Now the question is, do they know how to manage it once they get you in there?
So Sheeler says you're not appreciated, even if you've got $2 million in gross dealer concessions. If you're Danny, what are dealer concessions? Explain that to our vast listening audience.
They give you, so dealer concessions is where they give you like special deals, whether it's based on volume, based on production levels primarily.
Right.
But the dealer is going to give you, just like with car dealerships, the manufacturers will give the dealer concessions based on how much they're selling, how much they're moving. Has nothing to do with the quote end client.
No,
Yeah,
nothing
you're
to do
the
with the end
product.
client.
You're the product.
Nothing about Northwestern Mutual has to do with the person that's a client of Northwestern Mutual. Unless all you are to Northwestern Mutual is a $ walking around dressed as a fee. That's all you are to Northwestern Mutual. You're like the little Monopoly man walking around, and when Northwestern Mutual sees you, like that Pokemon Go game, like when you had your phone and you're like Pokemans. When Northwestern Mutual sees you, all they see you is a $ dressed as a fee. You're an F word to them. Fee. Let's see here. Even if you've got $2 million in gross dealer concessions, if you're not selling annuities insurance, you're not being appreciated. It makes it very hard to be objective, and you don't even see it while you're there. So look, I'm skipping around here to the most pertinent parts for our listening audience. I still, let's see here. Clients just, Sheeler goes on. This, by the way, this is not an axe to grind, this guy Sheeler, before anyone, there's a ton of advisors in this article that are saying the same thing. Clients just don't understand how they're paying their advisors, how they're paying their advisor influences these things. They're hoping to get unbiased financial advice, but they're not getting it. So Eric Rather of Canopy Wealth, who used to be with Northwestern Mutual, cites a $15 fee for stock and ETF trades at Northwestern, even as other firms have been cutting their prices to zero. Northwestern also charges a high program fee for its advisory platform, which meant that the smaller accounts, around $15,000 or less, would end up in brokerage accounts with shares of mutual funds that come with added loaded costs. So stock owners and market lovers, let me just break that down for you. And if I don't do a good job, Daniel, step in here. So we don't have any limits. We have no minimums here at Revere. We're here to serve investors worldwide and help them, one, preserve their wealth and then grow it. So that's number one. Number two, we don't use mutual funds unless a 401k program that we manage absolutely has to have us do that. Number three, we don't do loads. Number four, this company is trying at every turn, is Northwestern Mutual's feeing you up at every turn, Danny. Loaded, who's doing loaded funds in 2020? Northwestern Mutual. Right. And so as we you didn't work at Northwestern Mutual, right, Hunter?
Correct. No, I did not.
Okay. So
No
I should have asked that before we started this sojourn. But hey, here we are.
The follow-up question or the follow-up rebuttal is, I wouldn't have hired him if he had worked for Northwestern Mutual.
No, you would have saved him, Danny. You would have saved him, which is
only if he had worked there for about 6 months before they ruined him.
They wouldn't have ruined him. Hunter.
No, they corrupt. What do you think the BDs do, man? They indoctrinate you, and the insurance companies. They indoctrinate you into that.
So the subtitle here is Advisors or Salespeople, and a 2017 report. Now this is where it really gets interesting, and I think this Michael Kittis, man, what a swamp monker this guy is. I'm about to get to him here. Here we go. In 2017, the Consumer Federation, we have it. It sounds like some galactical thing that you would see in
I was about to say that sounds like the Klingons, you know.
Yeah, like Consumer Federation, pointed out how 25 firms, including Northwestern, Wells Fargo, Morgan Stanley, all the places you'd want to take your dog to take a dump at night, and Edward Jones presented representative, so true, presented representatives in marketing material under titles such as financial advisors, planners, and wealth managers. Yet the firm's trade groups sued the Department of Labor to vacate its fiduciary rule in 2016. They argued that reps were merely salespeople working on commissions. Now, the SEC's Reg BI, which is the regulation that's meant to protect consumers, which Danny and I and Don have advocated for, because we want you to be protected from these malcontents. Well, this Reg BI rule will force some changes upon the industry, such as prohibiting use of the word advisor for a representative providing only brokerage services rather than advisory accounts. Some duly registered firms could still opt to use terms such as financial advisor and financial professional. Northwestern and other brokerage firms that provide advisory services can receive commissions called 12B1 fees and asset-based fees on the same securities that they sell to you. They can also receive kickback payments. Danny, I've been saying kickback for years.
That's not even double dipping, that's triple dipping.
Danny, I've been saying kickback, stock nerds. I used to say the word kickback on the air when we didn't do video, and you should see the look on Danny's face. Stop calling them kickbacks. And I'd be like, screw it. I hate this industry for the people that swim in the swamp. Now you've got Financial Planning Magazine, the journalistic standard in this industry, calling them kickbacks.
Rebates.
Nice.
Dealer concessions.
They also receive kickback payments from the fund companies. If you're a client at Northwestern, at Wells Fargo, at Morgan, at the empty Edward Jones Dome in St. Louis, listen, if you have a mutual fund in your account, I think you can assume, or at least safely question, if the person who put it in there, you can question if that person was compensated for putting you in that fund. You need to call
how they're compensated. Yeah, you want to know.
Yeah,
all
you need
fees.
to ask the question. Hey, did you get some 12? If you tell somebody, did you get some 12B1 fees for putting me in XYZ mutual fund? They're going to choke on whatever they've got in their mouth, whether it's their tongue or a drink. They're going to choke because nobody knows what 12B1 fees are. You're going to be the most informed consumer in the market. They're going to know the gig is up. I'm telling you, they're going to know. You've got to ask the questions. If you're in mutual funds at one of the big name brokers or one of the big name banks, you've got to call the person who put you in those funds and ask. And if the answer is yes, run like hell. And if they refuse to tell you, run even faster. So Daniel, here we go. Ay, 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 ay. So let's see here. Here we go. Other experts, Daniel, I'm going to end with this. Other experts cut Northwestern a little slack. Now, who do you think, Danny, is going to cut Northwestern Mutual a little slack in this industry? Who do you think?
There are other competitors.
Effing swamp monsters, Danny. It's the only answer. Effing swamp monsters.
The other oligarchs in the business.
Yeah, oligarchs. How about the other people swimming in the sewage? That's who's going to cut these people a break. These other. So Michael Kittis, the financial fiduciary standard on Twitter. That was sarcasm. Did I do it well?
I caught it.
Did you?
I did.
Was it good? Okay. Anyway.
Hunter, are you handling all this okay?
Oh yeah, I am. I'm following right along.
Okay, good. I know you're following. I just want to make sure you're handling it okay.
Yeah, I'm good. I'm
Whether
good.
you were offended or not, that's what he said.
No, I'm not.
Other
You've seen some of these. Whoa. You've seen a few of these things before, haven't you, Hunter?
Well, I'm very familiar with. I have a bunch of buddies from college. Granted, just guys that graduated in finance with me.
Danny, you always like to end the romance. You just like to love them, and then you're like rolling over snoring. Just give me a second here. We're about to have what's known as a climax moment.
Well, they're all gonna be former buddies if they watch this podcast.
Probably so. Yeah.
That's all right. Bring them over. If we don't educate the youth, this will never change. It's only the younger people that, because all the old people have been sucked in by the television commercials. They sponsor the Rose Bowl. They gotta be good. What? Other experts, the Rose Bowl sucks, by the way. Other experts cut. Give me the Tostitos Fiesta Bowl. Other experts cut Northwestern a little slack, even as they expressed reservations about industry regulations. Now, this is the part that actually shocked me. Michael Kittis, a financial planning contributing writer and co-founder of XY Planning Network. So this dude writes for the Financial Journal, financial planning, the journalistic standard of this industry. So he's a contributor. And they're about to call him out. He must have done something to piss these people off, because they're calling out one of their own writers. I want you to think about that. They don't do that in any newspaper. They don't open up the newspaper and clean up the dog poop with it. And that's what they're doing to Michael Kittis when you hear the next thing I'm about to say. Michael Kittis, XY Planning, Michael Kittis unsuccessfully sued the SEC to block Reg BI. This guy who wants to be a champion for the financial services industry sued the regulating body to prevent protections to go in that would help individual investors.
He's protecting his turf, Tim.
He's in the swamp. He's in the swamp. He's in the
You know what? He's got a network of broker dealer. I mean, a network of financial planners that are insurance agents and brokers.
Danny, you are so my hero. I take back the fact that you roll over after sex. You don't. You talk and you whine and you dine and you romance, because the next thing I'm going to say, it's like you knew where I was going, and you don't, because you've never seen this article, because as we established, you don't read. Financial planning. Okay.
You tell my wife that for me, Tim.
I hear she's not a very good driver. Is that true?
She's very good. She's a hell of a lot better than you, Tim. I've seen you drive, man. Hunter, if you ever come to Dallas, do not get in the car with Tim.
No, I'll make sure.
He may be able to fly a helicopter really, really well, but man,
if I never had to drive again,
skills don't translate.
Oh, yeah, I tell you, the only one that drives worse than Tim in Dallas is Howard, the CPA.
I was going to say, do not say your wife AK. I really thought you were going to say AK.
God, she's a good driver.
Just not as good as you.
No, she rides a horse much better than me.
Wow.
He's only saying that because she might be within earshot.
I'm at the office, Tim. I'm at the office.
So Michael Kittis unsuccessfully sued the SEC to block Reg BI, has spoken at Northwestern conferences. He also works with, and this is where Danny was 1,000% right, he also works with dual registered firms through his online payment company, Advice Pay.
He helps them line up, get paid, set up. Yes, I know.
Oh my gosh, this guy is so bought off. Of course he's going to defend the swamp. It gets better.
He's not bought off. He's one of the leaders in that kind of industry, that group.
Northwestern.
Financial planning. We solved your problems with insurance.
Northwestern, according to Kittis, is leading the charge on the future of the fiduciary insurance channel, which is kind of a cool thing, because none of the other companies seem to be doing it, Kittis says. They seem pretty interested in trying to figure out how to actually be fiduciary advisors in the future. Not
okay,
now.
You want to know what that? You know what that means in plain English?
Yeah.
So they've had this. Remember, Tim, you and I've had this debate before. So you hated the industry. I said that's the way it was originally brought up in the 70s and 80s, and it's changing with, technology, internet. People don't want to pay big commissions and stuff. And so now they're stuck. The insurance companies are trying to figure out a way from shifting their old model into the future. Shifting. That's why I said shifting.
You said shifting.
Okay. Anyway, moving their model to the future. And so they're trying to come out, they're trying to come out with fee-based products. Well, the problem is then you cut the knees out from all the old commission-based guys. And they're trying to figure out how to do that seamlessly, because you can't really, once you start it, you can't gradually shift over. It's going to happen very rapidly. So it's going to be interesting to watch. And by the way, best interest is bogus. Best interest sounds like it's your best interest. It's in the best interest for the broker. Remember that. So hang on. What best interest means is you can have 5 different classes of the same mutual fund. If you're going to, we don't do mutual funds, but if you're going to do them, institutional class is the cheapest, the best for you, the investor. But you can have a retail class, you can have an A share, B share loaded funds, which Tim is talking about. So as long as it's suitable for you, meaning you're aggressive, you can get emerging markets, small cap. You're a wimp, you can get a bond fund, right? Well, if as long as it's suitable for you, they can put you in the most expensive share class, and that's still in your best interest. Can you explain that to me? How is that you can pay 3 times as much, but it's still in your best interest.
This is why we beg stock nerds and market lovers to talk to their loved ones about this, because it's not just Northwestern, it's all of them. So, but I mean, just break down this sentence.
If you, I'm reading online about why he sued, because you got me curious. And we would probably agree with the reason why he sued, because Reg BI would not have equalized the playing field. They were not going to mandate that BI be applied to broker dealers. So they were not leveling the playing field and leaving the double standard in place, and that's why he sued.
That's a lot better. I don't think he's a white knight in this industry at all. But I'm clearly I'm announcing my bias here.
I didn't follow that, Don. What best interest is for the broker deal, not a.
Okay, let me read. This is from his website for why he sued. In issuing the new BI interest rules, the SEC declined to equalize the standard of care for broker-dealer delivered versus RIA delivered advice, as was mandated by Dodd-Frank, and instead expanded the broker-dealer exemption that would allow them to more easily provide comprehensive financial planning without being subject to a fiduciary standard.
Okay, so let me put that in plain English. Because what that, he sounded good there. What that means is, so Rich, if you, like us, we're fee-based only, we're a true fiduciary. We only represent the client. Best interest, even though that sounds like best interest, means that's the broker dealer, that's the commission-based standard, the best interest. The regulators originally envisioned merging those two together and forcing the broker dealers, the brokers, to come under a fiduciary standard. Well, you can't come under a fiduciary standard like us if you're selling a bunch of commission crap. So they couldn't do that. And then the big lie, remember, Tim, you were saying a couple of years ago, it's about time, I'm glad. And I told you, just wait till the lobbyists, the insurance companies and the broker dealers get in, the lobbyists will crush that thing. So the lobbyists went in, gave Congress a bunch of money, and they watered the thing down, and they were trying to figure out how to try to make it so that it seemed like the same standard for both, meaning brokers could be like a fiduciary, which they're not, and still be it. Well, the fiduciary said, wait a minute, you can't try to pull us down to bring them up. And so finally they kind of backed off the whole thing, and they kind of left it somewhat alone.
Sounds like Michael Kitces was trying to protect his one of his bigger paying clients potentially.
He's kind of in the, I mean, look, he represents advisors and broker dealers, I believe. I mean, brokers too, not just fee-based.
Well, if he's representing brokers and he's suing because he says that they're still able to get away with murder, he probably doesn't have very many brokers as clients.
Well, that may be true. I'll have to do a little research on that.
I don't know how many, but it sounds, from the article, it sounds like he was protecting himself here, protecting his client base.
But it is going to be it's still an issue. And for the client, for the stock nerd, for the listener, for the end user, you need to figure out how your advisor gets paid. And is it straight up front, or is it through sharing fees from the quote selling side, the mutual funds, the insurance, the whatever? You should get your advice that's, in my opinion, fee-based only, and you pay directly to the advisor, and the advisor has no conflicts. And if you're doing business with quote an advisor that has the name of the brokerage firm, even if it's a discount one like Fidelity or Merrill Lynch or Morgan Stanley or Wells Fargo or the insurance companies, there's a conflict of interest. So just like in accounting, you want to have a separation of duties. You want to get your advice from somebody different than where you're custodying the assets, where the assets are held. And it should be fee-based only without commissions. That's my opinion.
Didn't we come across someone, Danny? I can't remember if it was last year, this year, where somebody asked their advisor the set of questions. You sent somebody a set of questions they should ask the advisor. And the advisor's response was, "I've got to eat too." Do I have that remembered properly?
Yeah, you do. They said, well, don't I, when they were talking about the 12B1 fees,
Oh, yeah, yeah.
they said, well, don't I deserve to get paid?
And they were already getting
They got
paid.
defensive. They got defensive. Yeah.
Yeah.
And that is, look, here's my problem. And Tim, you hate the way the business was set up. It was set up that way before. A lot of these guys are actually honest guys that are trying to feed their family. Here's my problem. If you set up a dishonest system, you're going to make thieves out of honest people because they got a family. They got to feed their kids too. That's the problem. I don't like the way that the whole industry, that's why I went to fee-based only. Even before I started with Veer in 2010, I was with a fee-based only firm, from the late 90s when you could first start really doing that on a large scale basis. I dropped my Series 7 a long time ago. And by the way, that's how you can really find out if you don't want to have the, fairly close, if you don't want to have the altercation with the guy or the girl where you say, how do you get paid? Where do you get paid? All you got to do is ask them, do you have your Series 6 or your Series 7? They'll think you're bragging about their license. They're broke. Oh yeah, I got my Series 7. And they don't realize. And then okay, they're a broker. There's conflict of interest.
Sneaky Dan.
You want to talk to somebody that, some people don't like conflict. They don't want to, I don't mind it. You just got to do it. But some people don't, rather not have that difficult conversation.
It is interesting that
you want people that
so
just
many
have
people,
Series 65. That's it.
I mean, there were actually rules being put in place to protect people from annuities, and they stopped it. Like it's absurd.
Well, look, here's what you really need to know. Now, again, I still don't think it's a good idea, and I'm not advocating for it. I've done it with a couple clients that inherited it from annuity from their parents. They had huge capital gains. They didn't want to, or income. They didn't want to take them out. But they're actually annuities that are actually fee-based, and they charge you like 30, 45 basis points. And they've got over 200 funds, long, short, even leveraged, short selling leveraged, professionally managed funds within that annuities. And you can put the money in today and you can take it out next week if you're not happy, no commissions, no nothing. And then you pay like an advisor like us to manage it for whatever fee we charge, right? And it's fee-based only.
We should dig into that. We should dig into that a little bit more.
And you never hear about those. You never hear about those because the guy doesn't pay a big commission, but they're out there and they're gaining popularity. But the reason, Don, they're still not that great is because annuities actually are tax disadvantaged. It's income first, return of principal second. So even if you have $100,000 in annuity, you grow it to $200,000. So now you got $100,000 in gains. When you take out until you take out 100,000, it's not even prorated. So if you take 20 grand out, it's not 10,000 of return of principal, 10,000 of capital gains. Or income. It's 10,000 income right off the bat. So it's until you take the gains out. So they're still not a great way to invest, in my opinion. You're still limited. Still can't do leading stocks. Still can't. So I mean, there's very few times that they are good for asset protection, whatever. But 95% of the time, 95% of the annuities I see are unnecessary.
Let's do this. Hunter, where'd you come from, man? How'd you show up at the Revere doorstep?
All right, guys. So just for starters, I'm happy to be here on my inaugural Revere Asset video. And I just want to say thank you to you three guys for bringing me on. I've enjoyed getting started and learning, really working closely with Don and understanding the methodology behind the portfolios that you guys run and have developed. But I came from Central Alabama, a small town called Prattville, which most people have probably never heard of, but it's very close to the capital of Alabama, Montgomery. And so I went to a school called Troy, which most people have probably not heard of either, but they are D1, as Don referenced.
Several years ago.
That's right. So Neil Brown kind of came in and took over from Blakeney, who was kind of a historical coach there. And Neil Brown actually did a really good job, and then West Virginia hired him. And so under the Neil Brown tenure, we beat LSU, and that's kind of probably Troy's biggest claim to fame, at least in like the last 20 years or so. But it was an interesting school. We had a good team. We had some guys that went to the NFL. Actually, we had a running back that went to play for the Cowboys. Never actually saw really any playing time, but I know he was friends with Ezekiel Elliott and Pollard and some of those guys. But I graduated from Troy with a degree in financial economics. I'd say probably about a year and a half or so into my undergrad degree, I really just got interested in the markets, and then I started spending egregious amounts of times, studying the market, developing screeners, evaluating different indicators, so on and so forth. And then really what got me into it is I like making money. And I realized, if I can put in the time and develop the knowledge and practice, I have an opportunity to make money here without having to, do manual labor, which growing up, I worked in construction. I cut grass. I was very entrepreneur minded. So I did a lot of work with my hands. And so, once I finished my degree in financial economics with Troy, I took a full-time job with Cap South, which is the firm I worked for previous to this, and worked there for about a year and a half roughly, and then moved to Jacksonville actually at the end of last year. And so how did I get to Revere, right? Cap South was more of a asset allocating and a buy and hold strategy, right? And so not that there's necessarily anything wrong with that, but I really was attracted to the active management style that you guys have. And, when I first met with Don, really what was very intriguing to me was the downside protection and the systematic selling approach, which is something that's very unique. And I think when you do that, and obviously your clients know this, what you're doing is you're limiting the severity of those huge drawdowns, and simultaneously you're harnessing the power of compounding for the benefit of your clients. And that's something a lot of analysis on just over the years. And so that was just something that really kind of piqued my interest. And then, on the buy side, and the participation in the upside, it's a very interesting approach as well, as opposed to, I think the common methodology is, oh, well, Exxon's down 50%. It must be a good buy. It's about, they're cheap now. And a lot of people, I think, are just kind of taught to think that, because that's kind of the overarching theme, in the investment world, if you're really kind of getting into it or you don't pay attention to it that much. But you guys were the inverse of that. And it's, we want to buy stocks that are strong, that are on the way up, that are showing relative strength. And that was something I liked as well. So that's really kind of what got me here. Me and Don really, communicate well. He's answered a lot of my questions, and I've enjoyed learning this far. But more specifically to my role, I think a concise way to put it here with Revere is I'm really diving into the data that's available to identify trends, patterns, and opportunities, hopefully in an effort to enhance returns for the Revere Asset Management team. Is that pretty solid run through there?
I think
Yeah,
that was
you're a big stats guy too. You like a lot of math and stats. That's one of the things that attracted me to them.
Yeah, well, I like numbers and spreadsheets, and not many people really love that stuff. So
Don sleeps with an Excel spreadsheet every night.
I've looked at them. I know.
If you like spreadsheets, you and Don will be holding hands within a week.
Well, I've been going through Don's, and they are quite rigorous and complex, but I enjoy the challenge of trying to understand everything he's done this far. But I like data, identifying correlations and patterns.
Let me know if you figure it out.
So polite.
I'm working on it. So
polite. Yeah. When you figure that out, Hunter, could you add a tab to the spreadsheet and type?
It might be pretty extensive. So no promise.
Let's do this, Danny. We're going to get to where we think markets are headed, stocks we're looking at, things we did, that type of stuff. Build a watch list for some clients. Let's do this. End the show, do the show ending now, and then I'll come back with Don's thoughts on stocks and markets. I got some things I want to say about which is going to drive the market in the coming week, and then we'll be done. So take it away, Danny.
All right, folks. Well, first of all, I want to welcome Hunter to the Revere team. And as soon as I get my IT guy to add his picture right there, we're going to add him somewhere on there. Listen, folks, if you like what you heard, please tell a friend, tell a neighbor. Just tell them to go to revereasset.com. They can hit the subscribe button, and they can sign up for this podcast, go right to their inbox, and they'll get our daily market insight that Tim and Don alternate doing every evening. And we promise we won't spam, as you know, we don't spam you, we don't harass you. It's up to you to reach out to us. You can also sign up for the webinars page, which Don needs to do another one here pretty soon. And that he does that about once every month and a half, time permitting, on Wednesday at noon Eastern time. And even if you're working or you can't attend, we'll send you the webinar link. It's about an hour long. And if you got any questions or comments, you can email any of us at dan@revereasset.com, Tim at Revere Asset, Don at Revere Asset, or now Hunter at Revere Asset. You can also check out our Twitter handles at @1 Danny Stewart, at TJ Riazor, and at D Vandenborg. And you can also call us old school at 855 Real Wealth.
Look, Twitter is the easiest way to get a hold of me. I appreciate the emails. Danny likes phone calls. I don't know where Don stands on emails or phone calls, but if you follow us on Twitter, what that allows us to do is follow you back, and then we can message with each other just like we're texting buddies. Twitter for me is brevity. It's the easiest way for me to communicate with you. If you want to send emails all you want, I'll answer them. It just, some emails are longer than others. Twitter is always short and to the point. So I appreciate Twitter more. And you can just, look, even if you hate social media, just follow us. And I believe Hunter has a Twitter, which you'll figure out that he uses for research purposes only, that he doesn't really post too much, I guess. So let's do this. Don, what are your thoughts? And then what did you do this week?
So on the 920 podcast, I talked about how since 9/3 we had been trading, the S&P had been trading in a range from 33.10 to 34.30, and we broke below that. We got on the 18th of September, we stayed below it for about a week. We got back into that range. When we broke below it, we got more defensive, got back into it. Leaders continued to act well. We added exposure. And then Thursday, we finally broke above that 34.30. And as long as any pullback is contained by that 34.30 level in the S&P, the market is in great shape. Leaders are continuing to knock the cover off the ball, and that's our bread and butter. So a couple things that have gotten weak this week. DraftKings with its
I have not done a
secondary
good
offer.
job with this stock. This stock is on the chopping block for me. So is Penn. Like these have given up the ghost way too quickly. As a matter of fact,
Yeah,
Daniel, let us load up. Let us load up DraftKings and Penn. Go ahead, Don. I'm sorry.
I closed both of those out earlier today. Penn's making a little bit of a comeback, but Penn's looking at its second close below the 21.
Yep.
DraftKings, there's been the COVID issues in the NFL. There was more. The Jets' entire team, I think, was sent home today.
Hold on a second. Because of COVID or because they suck? Because that is two different issues, Don.
There are some
the facts.
There are some people that would argue that the Jets wouldn't show up anyway, but now they may actually not show up.
Are you serious? Like I haven't been following any of this. That just happened today?
That happened today, yeah. And DraftKings reversed when that happened, now down 4%, going to have its second close below the 21 and its second close below the offering level of 52, which was already pretty low. So that's been the weakness in the portfolio. The strength has been some things got like more than 20% extended from the 21, and I cut a little bit. I took a little bit of profits in Beyond, Novacure, and Roku, and pyramided into Zoom this morning, and Fastly has continued to just crush it.
This stock is this is, you know what, this is a good thing. Like this is why people get just real quick, people get fascinated with options once they start trading them. This stock will kill you with options. The premiums suck. It looks like people will talk about how much Fastly has moved this year. This stock is a premium killer unless you just get these 3 days right here. That's a tremendous move. That's a brilliant move the last 3 days in Fastly. Just a minute.
They inked a deal with Google supposedly, and that was what the big move up earlier this week was tied to. Made the big move before the announcement of the deal. I'm sure nobody knew anything about
Somebody
that coming.
always knows. Yep, yep. All right. Is that what you got?
That's it. 3430 critical on the S&P.
Yep.
Keep an eye on that.
So I'm looking at the futures here. So I went through this earlier in the video. I'm not going to do it again, but look, this NASDAQ up to the 618, it still has room to run. I don't want to use the word expecting. I'm anticipating, I'm thinking that there's going to be a FANG explosion next week, Daniel. FANG explosion. I'm thinking that the NASDAQ on Monday or Tuesday has itself a time, catches up to the other indices, and you're going to see things like Amazon, Netflix, which has been having its, I'll tell you what, the movie theaters shutting down has been you've seen Netflix from this consolidated little cluster here start to try to break out of it. And I believe that's theater related. I can't remember the last, Don, you trade Google? Google's just awful. I don't trade Google.
No. You know, Microsoft, Amazon, Google all have 3-month relative strength under 40, which is just terrible. So if they do get a bid, you're right. They're really gonna crank.
Yeah, and so I like Apple, but I like Apple more. It's market sensitive, and so you could just go out and buy the Qs if you're Apple, Amazon, Netflix. They're all market sensitive stocks. Stocks like Beyond Meat, Roku, Peloton. They're not market sensitive stocks. They're more what's it, honey badger-esque, for lack of a better phrase. And so, yeah, well, it doesn't mean they're invincible. You know, I like Zoom on a daily chart is, God, this is one of the most, this chart of Zoom is so emblematic of, Don, you remember when Chipotle made that run? It was like the last decade, and maybe it was coming out of 08, but it was certainly part of the last decade. It just rode the rails of the 8 all the way up. And Zoom's doing that. But Zoom will kill you with calls. I mean, if you got this is a premium killer. That's why it's so much easier to just trade the equities. But this is a beautiful pennant that's forming right here on the daily chart. I am looking for this to take out 530. It doesn't mean it'll happen, but that's one of the prettiest. We've got that in the shop, as Don mentioned, across, I think, all the portfolios now. I think what's going to drive the train, though, is this. It's the market's reaction to the dollar. And so here's a dollar on a daily chart. And so look, if you can't interpret the intercorrelated assets, I think that puts you at a disadvantage sometimes, because that leaves you to trade the news, or if you can't interpret price information. And so the dollar on a daily chart is starting to break down. And so that when the market was getting weak, what was the dollar doing? Yeah, it was getting stronger. When the market started to find its footing, look at this, 924 was when the market tried to rebottom and it couldn't. And then look, you can see the dates ticked off here. And then the dollar starts coming off, and the market's doing what? Going higher. And so, man,
that explains why gold and silver are strong today too.
Yeah. And gold and silver right now are proxies. If you look at the futures, gold and silver are. By the way, gold's been doing nothing here for a while. It's digesting this huge move. They're inflationary, meaning if the market's going up, the dollar's probably going lower, inflationary type assets. But gold and silver are not your hedges in this market, because when when stocks tank, is what I was trying to say, they are underperforming. And by the way, Danny, you, Don, and I have been talking about this for years, the death of the 60-40 portfolio. I've seen this written more and more places every day, how the people that have the 40% bonds it must be like a wave, Don, of clients just bitching and kvetching about how these nimrods have their people in 40% bonds, when bonds have just been a death knell to a portfolio. Danny, what are bonds paying you?
Pretty soon you're going to be paying them.
Is Michael going to sue the bond industry?
Even longer term, 20, 30-year maturities are way under 3, and even 2 if you're lucky. I mean,
I heard BlackRock talking horribly about the 60-40 portfolio, and I thought, holy hell, if BlackRock's dissing this, it must be a fever across the world where people are like, why are we doing this outdated model?
Your favorite buddy, Goonlock, the Bond King, the new Bond
No,
King.
Danny, that's your boy.
Even said, and this is this business. This is what he deals in. Even said, yeah, bonds are horrible. You're not going to don't buy and hold bonds right now. It's he's even dishing it.
Yeah, and the market has forced you into they're going to, I want to use the phrase riskier assets. But if you have a buy rule that triggers you into an equity, and then you have a sell rule that triggers you out of, Danny, when you have those two stocks loaded, just punch out of them, by the way, please. Yeah, I think it's not as risky. You can step into any market, but understanding that me always starts with an understanding of what are the four major indices telling me, and then from there, what do I think is going to happen? And if 70 to 80% of stocks all trade with the indices, well, then I can start figuring out what's outperforming relatively, and then I can start easing into that. But look, I don't have a portfolio. My portfolio differs a little bit from Don's. I shouldn't say that. I don't know if it has a Walmart in there, which is still doing well, just a little bit slower. This is a beautiful end consolidation here. Or even a Chipotle, which isn't really going gangbusters here, but this is a, man, I think Chipotle just takes this out before earnings. I'll be surprised if it doesn't try to make a run. Earnings are on 1023, 1021 in Chipotle earnings, and even slower things here. Look at Visa having itself a day, Danny. I mean, these are just really nice moves coming off of here. So there's Don, what else you got in the portfolio? Do you have anything slow in there?
Pins is the slowest. That's just consolidating very nicely. When I want something slow, I own a 2 times S&P ETF, which is kind of a weird thing to say, but it does cushion the portfolio on the days that the value stocks outperform, being in the S&P, because all the rotation takes place within the S&P 500.
And then, Danny, we're going to talk about this after so I was talking about Domino's. I'll end it with this here on Domino. Oh, I've got a couple stocks I want to make sure we're watching for next
Builder
week.
too. That's my slow stock. Nice
Yeah,
chugger,
Builder.
slow and steady grinder higher.
I've had the housing trade on since July, beginning of July into June, where DHI, Lennar, I added Builder that one week when you brought it to my attention, and then I had Restoration Hardware forever and a day. This Domino's is breaking down here, and it's really at my level of go, no go, and I didn't think it would get there, but here we are. So, and what's go, no go for me? Well, here's the weekly 21, which is held, and it's about 388. And so on this current chart, like the weekly 21 really hasn't given way. This is the March sell-off. So if the weekly 21 isn't going to hold here, I really don't want to. I'll take my small gain and just move on. I can redeploy those assets and other facets of the market than maybe what Domino's is doing. Even if it doesn't break that level, maybe just sell it because it's going to consolidate here. Clearly, the market didn't like the quarter from yesterday. That's now down 10% in 2 days. So
it also broke the low of the gap down day, which from the gap webinar I did is a big red flag. That's sometimes when you get big volume gap downs like that, it gets everybody out and it holds, but that hadn't been the case.
There are potentially better things working here. Like, and I've started small. So like I've got a Zoom position here that I really like. It maybe I added that at 2.5%, and I can do things like just add the other 2.5% there. So it's not so much as finding new things, maybe adding. And by the way, position sizing is absolutely positively your best friend for controlling risk and allowing you the opportunity to add. Danny, I like Zoom. I do think Peloton goes to 125. Got anything else? Oh, and I think Amazon's I talked about Amazon it's got earnings the 3rd week of October here. So we're getting into thinking next week's options expiration. So markets tend to rally into that, but then settle down that Thursday and Friday as options expire. And then we're in the thick. Earnings season for me isn't the banks. Earnings season for me is when Netflix starts to report and it starts that tech cavalcade, Danny. It's like when you used to watch the parades of Yvonne Lendl, Boris Becker, the dude who used to play John McEnroe.
Jimmy
Who
Connors.
was that guy? No, the other guy.
Bjorn Borg.
The wooden racket. Bjorn Borg was his waffle maker.
Yeah.
Bjorn Borg. Yeah. A cavalcade.
So I already got rid of DraftKings and Penn, Tim.
Yep.
And actually, while you were doing the show in the middle, because I knew you were preoccupied working on the show, I sold Domino's already about 20 minutes ago when it started breaking down on bigger volume. It went from down about 1.7, 1.8 to about 2.1. We booked about a 5.5, 6% gain on it. But it was showing weakness. Like I said, those three break it down, and that's what you need. You need to have a sell discipline so you don't, give up the ghost and get creamed.
All right. I think that's all I got, Danny. Y'all ready?
We'll talk to you next week on Your Money.